all the due diligence has been done, all of the legal documents have been done, everything's ready. The deal then becomes locked. So once the legal documents have been negotiated, buy side, which is you, sell side, which is the seller, both of their attorneys are kind of happy, all the fine print, all the details have been worked out, all the due diligence has been done, you're ready to close the deal. Hey guys, Carl Allen, welcome to day number 9 of 10 days to your first deal. So yesterday, day 8, we were talking about deal execution. We talked about signing an LOI, what needs to go into that. We talked about proof of funds and term sheets from lenders or investors that are going to partner with you in this deal. And then we talked about building that deal team on a contingent fee basis so that they'll do most of the heavy lifting for you when it gets to papering the deal and getting it ready for close. We're talking about due diligence. We were talking about legal contracts and different legal structures as well. So all that work's now being done and it's closing day. It's time for you to close the deal and take ownership of the business. So there's 2 things I want to talk about today. The first thing I want to talk about is what happens on closing day. And then number 2 is how you can get ready for growing the business, which is what we're going to talk about tomorrow, day number 10. We're going to talk about the importance of a general manager, a GM, somebody that's going to run the business for you and pull the levers on growth, which is what tomorrow is all about. So all the due diligence has been done, all of the legal documents have been done, everything's ready. The deal then becomes locked. So once the legal documents have been negotiated, buy side, which is you, sell side, which is the seller, both of their attorneys are kind of happy, all the fine print, all the details have been worked out, all the due diligence has been done, you're ready to close the deal. So all you do is you can sign deals virtually these days. You can go on DocuSign. I've done lots of deals recently by DocuSign. Traditionally, and this still kind of happens a lot more in the UK than in the US, is you'll rock up to the lawyer's office and you'll physically sign the documents. Last time I signed a deal in person in the United States was just before COVID. All the other deals that I've done since, I've done virtually, but it's still commonplace in a lot of countries to actually rock up and sign. So you typically go to the seller's lawyer's office. So you'll be there, the seller will be there, your CPA will be there, his CPA will be there, and all the documents will have been pre-agreed. And basically there's piles of documents, all with those little yellow stickers, and you go through and you both sign your name in all the different places. Now let's talk about before that. Let's talk about 24 hours before that. Let's talk about the funding flows. How does the money flow between the deals? So what happens the day before is there's an escrow. So there's an escrow account. Escrow is an American term. It's a legal process in America. In England, what happens, and in Australia and Canada, financiers just part the money that you're going to use for the closing payment with your attorney, and it goes into what's called their client account. In America, they have a special process for it, and it's called escrow. All you need to think about is it's a bank account where that money can't be touched, it can't be moved unless certain things are going to happen. And the thing that's going to happen with you for that money to move is you're going to sign the legal contract, take ownership of the business. Could be an asset purchase, it could be a stock purchase. We talked about that yesterday. But whichever method you're using to buy the business, you're going to be signing a legal document. And until that legal document is signed, the money can't move. So the day before, or even on the morning of closing day, money goes into escrow. So it could be money from a lender, if you're doing asset-based lending, if you're borrowing against receivables, inventory, real estate, you're doing the sale and lease back of any fixed assets like equipment and vehicles and all those different things. All that money gets parked into escrow. It could be money from the business. So if you're using surplus cash as part of the closing payment, cash that's sat in the business that is not required in order for it to trade. Remember yesterday, we talked about setting a minimum level of working capital, 2 months revenue. If there's 1 year's worth of revenue in the business in terms of working capital, that's surplus cash, you don't need it. So that could be used as part of the closing payment. You might have an investor. So you might have a partner. Remember going back to day number 7, when we talked about offers and negotiations as part of the offer stacking sequence, we had other investors coming in with cash to partner with you in the deal and taking some of the ownership. So if they're putting money in, that will get put into escrow as well. If you're going down the SBA route, so the SBA structure is typically 10% buyer equity or investor, 80% SBA financing. It's a cash flow lend. It's not secured against assets. It's based on the cash flow the business generates. And then there's a 10% seller financing note. So if you've got SBA money, which in your case would be 80% of the deal, sometimes a little bit higher, that would go into escrow as well. So on the day before the deal or the morning of closing, that escrow account is going to be full of cash. It's the money that's going to flow through the deal as soon as you sign the document. So then what happens is you sign. So all the money's in place. You can't sign the contract until the money is in escrow or it's in your lawyer's client account. As soon as that money is there, then you can sign the contract because the seller knows they're going to get their money because the escrow will release that cash as soon as you sign the contract. So you sign the deal. So once you sign the deal, you now own the business. So instantaneously, as soon as that happens, then the money can come out of escrow and it goes to 2 places. So place number 1, it goes to the seller's lawyer. Okay. So that's the closing payment. So that goes to the seller's lawyer, and then the seller's lawyer is going to do 2 things with that money. Number 1, they're going to go and pay closing costs, play fees. And then number 2, they're going to give the balance of the money to the seller, that the seller's going to do whatever the seller's going to do with that. Typically, the lawyer doesn't withhold tax. It's up to the seller to take that money and then deal with any tax that is liable to them to pay to the IRS or the HMRC in the UK or wherever they are. It's for them to deal with. The second portion of the money, if there's any surplus money left in escrow over and above what needs to go to the seller's lawyer, that goes into the business. You now own the business and the business owns that money. So that money goes into the business and then you can do whatever you want to do with that money if it's surplus. You could take it out as a deal fee. Sometimes we talk about taking a little bit of money off the closing table. That's where that money goes back into the business. Then you'll take it out as a dividend or as a fee or however you want to do it. Or you might want to leave that money in to buy another business, or you might want to leave that money in to hire some more people, to scale, to do lots and lots of different things. So that's your money. You're now the owner of the business. That surplus cash goes back into the business's bank account and it's yours. You can do whatever you want with it. So that's how the funds flow during the deal. Now, there's a common, well, it's not a myth, it's actually true. There's a common phrase in doing deals. People say, well, how could you borrow money against a business you don't own? And that is absolutely true. You can't borrow money against a business you don't own. This is where the escrow comes into place. It's exactly the same process as a real estate transaction. So if you were buying my house, you would go to your mortgage company or the lender and you would say, hey, I want to buy Carl's house. It's worth $3 million. I've got $500,000 of cash. I need a $2.5 million loan to buy his house. They're going to lend you the money, which then goes into escrow and then moves through as soon as you sign the purchase contract to buy my house. Exactly the same when you're buying the business. All the money goes into escrow. It then flows through to the seller's lawyer. Surplus cash then goes back into the business once you've signed the documents and you legally own the business. It happens instantaneously. Really, really important. So that is what happens at closing. The second thing that happens at closing is obviously you're taking ownership of the business. You then need to figure out who's actually going to run the business for you. Now, you must have figured that out beforehand. And there's 2 things. You can either be an owner manager, so you're going to go in, you're going to run the business day to day, so the business has got to be somewhere close to you, or you're going to have a general manager come in and run that business for you. Now, every business is a 3-legged stool. Okay, it has a sales and marketing function. It has an operations function. The sales and marketing function Their job's to go out and make a promise to a customer for a product or a service. They do that. The operations function then to deliver on that promise, to build the product, the service, deliver it to the customer, etc. And then you have a finance and admin function, okay? The finance and admin function is the glue that really keeps the business running. And then all those three departments or department heads, so your sales and marketing director, your ops director, your finance director, your CFO, whoever it is, they all report to what we call an integrator. So that's your GM, your COO, the person that's running the business day to day. They're doing all the tactical day-to-day work. They're driving the bus. And then above that is what we call the visionary. So the visionary is you. That's the owner investor. So your job's to set strategy, to drive the culture, to be the leader, and you'll do more deals, JVs, all those different things. You're not doing any of the work inside of the business. You're working on the business. Your GM is working in the business. Now, what I always do with a GM is I give them some equity in the business. Really, really important, because that changes their psychology. It turns them from being an employee to being a business partner. So they're going to work harder. They're going to smash through the walls to help you grow that business because they own a piece of it. So not only as a shareholder, as a partner in that business, are they going to get a salary, they're also going to get distributions because they're an owner. And then together, if you grow that business, then you sell it for a lot of money, your GM is going to get a little piece of that as part of the exit because they're a shareholder with you inside of the business. Now, you don't need to give them all the equity at closing. You can vest it. And what does that mean? It means you can drip the equity to them over time. What you don't want to do is say, hey, there you go, I'm going to give you 20% of the company. You're going to run it for me. We're going to be partners. You give them 20% of the equity. The following day, they say, yeah, you know what? Yeah, I don't want to do this. I want some money for my 20%. So what you do is you vest it. You might give them, say, 5% initially, and then you might give them 5% after 1 year, another 5% after 2 years, final 5% after 3 years. Or rather than vest over time, you might vest that money based on some financial milestones. So, hey, if you get the revenue from 1 million to 1.5 million, I'll give you an extra 5%. You get it to 2 million, you get an extra 5%. Or you could do it on profitability, which is the safer bet. So let's say the business is doing $1 million now in revenue, $200,000 a year in EBITDA and cash flow, 20% margin. You say, hey, I'll give you 5%. You get that business to $300,000, you can have an extra 5%. You get it to $500,000, you can have an extra 5%. You get it to $700,000, you can get your final 5%. So you're incentivizing that GM to stick with it and help you grow the business, which is separate to the time element that it's going to take. So that's what we do. So day 9 closing, we talked about what happens on closing day. We rock up at the lawyer's office. We basically sign the deal, or these days you can do it over DocuSign. Critical thing, day before or the morning of the closing, all the money's got into escrow. If the money's not in escrow or in your attorney's client account, you can't close the deal. As soon as you sign the deal, whether it's DocuSign or paper sign, the money then flows through to the seller's lawyer. The surplus bit goes into the business. You can do that whatever you want. And then we talked about the role of a general manager, having a GM in place to drive the bus, to run the day-to-day for you. They're working in the business, doing the tactical work, leaving you to work on the business, doing the strategic work. And we also talked about how GMs can get incentivized. Give them equity. Give them equity to help you grow the business, changes their psychology, but really, really important, vest it over time to protect yourself. So that's closing, that's GMs. Tomorrow, final day, we're going to be talking about growth. I'm going to show you the 2 amazing ways to grow a business. One is to buy more deals. The second is to grow it organically. And I'll show you a really neat kind of 3-step trick to be able to do that very, very quickly. So I hope you enjoyed that. And I will see you tomorrow on day number 10. Until then, bye for now.
Hey guys, I'm Carl Allen. I'm the founder of Dealmaker Wealth Society. I've done tens of billions of dollars of deals over the last 30 plus years. If you're new to my channel, definitely hit like and subscribe so that you can get all of my amazing Dealmaker content in real time. You're not going to miss any of the outstanding information that I'm going to share with you. And if there's a question that you've got, if there's something that you want to know the answer for and you want me to speak to it, definitely hit me up in the comment section and I will record those videos for you and I will get them on this channel as soon as possible. So love having you part of this YouTube community and I can't wait to serve you. Until then, bye-bye for now.